Tesla just reported its worst sales numbers since 2022. Q4 2025 deliveries fell 15.6% to 480,227 vehicles, missing Wall Street estimates by 25,000 units. And for the first time ever, BYD outsold Tesla globally, delivering 2.26 million EVs compared to Tesla's 1.64 million. This is a complete collapse. Full-year Tesla sales dropped 8.6%, the second consecutive year of declines. The company that was supposed to revolutionize transportation is now losing market share to Chinese competitors and struggling to sell cars in its home market. But here's what caused this disaster. Two massive shocks hit Tesla simultaneously: Elon Musk's political backlash and the end of the $7,500 federal EV tax credit that Trump eliminated in September 2025. Musk's decision to lead Trump's DOGE, Department of Government Efficiency, and fire thousands of federal workers created a customer revolt. Progressive buyers, who make up the majority of EV customers, boycotted Tesla. Protests erupted at Tesla facilities. Don't Buy Tesla campaigns went viral. Then Trump killed the EV tax credit at the end of September, making every Tesla effectively $7,500 more expensive overnight. Customers who were planning to buy rushed to purchase in Q3 before the credit expired, pulling forward demand. Q4 suffered the aftermath, a 22.4% sales drop in the US alone. And Tesla's response? Launching standard versions of Model Y and Model 3 that cost $5,000 less than base models, not nearly enough to offset a $7,500 tax credit loss. In this video, I'm exposing why Tesla sales hit a 4-year low, how Musk's political moves destroyed the brand, what the tax credit elimination really means for EVs, why BYD just crushed Tesla globally, and whether Tesla stock can survive as Musk pivots from cars to robo-taxis. But before we dive into Tesla's collapse, if you want to understand how CEO behavior affects stock prices and protect your portfolio from companies in crisis, subscribe to The Investor's Lens. We reveal the truth about failing companies. Hit subscribe now. But there's one factor that destroyed Tesla sales that is by far the most self-inflicted, and it reveals how CEO behavior can crater a company. It's the Musk political disaster. And the numbers prove it cost Tesla billions in lost sales. Let me walk you through what happened. In November 2024, Elon Musk became one of Donald Trump's most visible supporters, contributing over $100 million to his campaign and speaking at rallies. After Trump won, he appointed Musk to lead DOGE, the Department of Government Efficiency, tasked with cutting federal spending and workforce. From January to May 2025, Musk spearheaded mass layoffs of federal workers. Entire agencies were gutted, tens of thousands of government employees lost their jobs, and Musk celebrated these cuts publicly on Twitter X, calling it draining the swamp. The backlash was immediate and severe. Protests erupted at Tesla facilities across the country. Don't buy Tesla. Hashtags trended on social media. Progressive groups organized boycotts. Federal workers, a significant customer base for EVs due to environmental consciousness, stopped buying Teslas entirely. Remember, Tesla's core customer base is educated, higher-income, environmentally conscious progressives. These are people who care about climate change, social justice, and government services. When Musk fired their friends and celebrated destroying federal agencies, they felt betrayed. A survey conducted in early 2025 found that 38% of potential Tesla buyers said they would not consider purchasing a Tesla specifically because of Musk's political activities. 38%. That's not a small segment. That's nearly half the target market walking away. Tesla's brand value took a massive hit. The company that was once seen as cool, innovative, and mission-driven became toxic to its core customers. Owning a Tesla went from status symbol to political statements supporting Musk's right-wing activities. Cox Automotive data shows U.S. Tesla sales fell to near four-year lows, the lowest since January 2022. In November 2025, U.S. sales dropped 23% year-over-year to just 39,800 vehicles. This was before the tax credit ended, meaning the decline was purely from brand damage. And Musk didn't just alienate progressives, he also frustrated conservatives. After months of leading Doge and making enemies across Washington, Musk quit in May 2025, saying Doge was only somewhat successful and he wouldn't do it again. He made all those enemies, destroyed Tesla's brand with progressives, and then quit without accomplishing his stated goals. Now Tesla is stuck in no man's land. Progressives hate Musk for his politics. Conservatives were never the EV customer base to begin with. They prefer pickup trucks and generally oppose electric vehicles on principle. Musk alienated the customers who actually buy EVs without gaining new customers who don't. Ross Gerber, a prominent Tesla bull investor who once defended Musk religiously, publicly called for Musk to step down as CEO, saying, "Elon has become a liability to the brand, and he's alienating the exact customers Tesla needs." The worst part? This was completely avoidable. Musk could have stayed focused on Tesla, SpaceX, and his companies. Instead, he chose to dive into controversial politics during a critical time for Tesla. Right when competition was intensifying, the tax credit was ending, and the company needed to defend market share. It's one of the most spectacular self-inflicted brand destructions in corporate history, and Tesla sales numbers prove it. But the political backlash wasn't the only shock to Tesla sales. This next policy change is perhaps the most devastating because it made every Tesla $7,500 more expensive overnight with no warning. It's the federal EV tax credit elimination, and the timing couldn't have been worse for Tesla. Here's what happened. The Inflation Reduction Act of 2022 created a $7,500 federal tax credit for qualifying electric vehicles. Buyers could claim this credit on their taxes, effectively reducing the purchase price by $7,500. For a $45,000 Model 3, the net cost was $37,500 after credit. This credit was scheduled to remain in effect through 2032. But Donald Trump, who campaigned against electric vehicles and called climate change a hoax, eliminated the credit effective October 1, 2025, 7 years early. The impact was immediate and predictable. In Q3 2025, customers rushed to buy EVs before the credit expired. Tesla had an unexpected sales surge that quarter as people scrambled to claim the $7,500 credit. Dealerships were packed, wait times extended. But that Q3 surge pulled forward demand from Q4 and beyond. Everyone who was planning to buy a Tesla in late 2025 or early 2026 bought in Q3 instead. And then in Q4, after the credit ended, sales collapsed. Q4 U.S. Tesla sales dropped 22.4% according to Cox Automotive, falling to 125,900 units from 162,300 the previous year. The company's quarterly deliveries of 418,227 globally were down 15.6%. Let me explain why this is so destructive. A $7,500 price increase doesn't sound catastrophic, but for many buyers, it pushes Tesla out of reach financially. A Model Y at $47,990 after $7,500 credit was $40,990 net, affordable for upper-middle-class buyers. At $47,990 with no credit, it's suddenly competing with luxury brands like BMW and Mercedes. And there's a psychological component. When you tell customers this costs $4,490 after credit, they anchor on that price. Then when the credit disappears and the actual price is $47,990, it feels like a massive price increase, even though Tesla didn't raise prices. Tesla tried to respond by launching standard versions of Model Y and Model 3 in October 2025, stripped-down versions priced about $5,000 below previous base models. The standard Model Y costs just under $40,000 and the standard. Model 3 is under $37,000, but here's the problem. These standard versions have less range, fewer features, and lower performance. They feel like budget models. And even with the $5,000 price cut, they're still $2,500 more expensive than the old price with the tax credit. Plus, these new budget models disappointed investors who expected a meaningfully new mass-market product, not just stripped-down versions of existing models. Tesla hasn't launched a new vehicle since the Cybertruck. Customers want innovation, not cost-cutting. The tax credit elimination also hurt Tesla disproportionately compared to competitors. Chinese EV makers like BYD already sell vehicles for $25,000, $35,000 in international markets. They don't need tax credits to be affordable. Tesla's higher prices, even with the standard versions, can't compete on price alone. And here's the irony. Elon Musk supported Donald Trump, who killed the EV tax credit that was helping Tesla sell vehicles. Musk, literally, backed the politician who then destroyed a key driver of his company's sales. It's unclear whether Musk understood this would happen or if he thought Tesla was strong enough to survive without the credit. Either way, it was a catastrophic miscalculation. The combination of Musk's political toxicity plus the $7,500 tax credit loss created a perfect storm. Tesla sales didn't just decline, they collapsed to 4-year lows. But while Tesla was collapsing, one competitor was absolutely crushing them. Here's the competitive reality that marks the end of an era, and it happened while everyone was distracted by Tesla's internal problems. It's BYD's global takeover. And for the first time in history, a Chinese automaker outsold Tesla in annual EV sales. Let me give you the numbers. In 2025, BYD delivered 2.26 million battery electric vehicles globally. Tesla delivered 1.64 million. That means BYD sold 37% more EVs than Tesla, a massive margin. This is historic. Tesla has been the global EV leader since electric vehicles became mainstream in the 2010s. The company defined the category, created the premium EV market, and built the supercharger infrastructure that made EVs practical. But now BYD has taken the crown, and it's not close. How did this happen? BYD's strategy is simple: produce affordable, high-quality EVs and flood every market possible. While Tesla focused on premium vehicles starting around $40,000, BYD sells quality EVs for $25,000, $35,000 in international markets. In China, the world's largest EV market, BYD is dominant. They hold massive market share while Tesla has fallen to 7th place, behind 5 Chinese competitors. Tesla's China sales dropped 49% in February 2025 compared to the prior year. BYD kept growing. But here's what's really impressive. BYD's international expansion in 2025 was explosive. Sales outside China climbed to a record 1 million vehicles, up 150% from 2024. That's triple-digit growth in international markets. BYD is now expanding aggressively in Europe, Southeast Asia, Latin America, and the Middle East. They're opening dealerships, building factories, and undercutting every competitor on price while maintaining quality. In Europe, BYD's growth has been particularly strong. While Tesla registrations declined across much of Europe in December 2025, BYD's sales surged. European buyers facing high energy costs and economic uncertainty are choosing affordable Chinese EVs over expensive American brands. And BYD isn't just competing on price. Their vehicles are technologically competitive. They manufacture their own batteries, unlike Tesla, which buys from Panasonic and CATL. They've developed blade battery technology that's safer and cheaper than traditional lithium-ion batteries. BYD also benefits from Chinese government support, subsidies, favorable regulations, and access to raw materials. This gives them cost advantages Tesla can't match. The company has announced plans to sell 1.6 million vehicles outside China in 2026, another 60% growth. If they achieve this while Tesla continues declining, the gap will widen dramatically. What does this mean for Tesla? It means they've lost the EV sales crown permanently. BYD isn't a flash-in-the-pan competitor. They're a manufacturing powerhouse with economies of scale, government backing, and a winning strategy. Tesla's response has been to pivot away from the car business entirely. Musk is now telling investors that Tesla's future isn't in selling vehicles, it's in robo-taxis, humanoid robots, Optimus, and AI. He's essentially admitting defeat in the car market by saying, vehicles don't matter? Look at our other projects. But here's the problem. Tesla's revenue is still 75% from vehicle sales, $21.2 billion out of $28 billion in Q3 2025. They can't just pivot away from cars without replacing that revenue. And robo-taxis and robots are years away from meaningful profitability if they ever achieve it. BYD just proved that Tesla is no longer the undisputed EV leader. The Chinese are winning the EV race. And Tesla is struggling to stay relevant. So what does all this mean for Tesla stock? Here's the investment puzzle that makes no logical sense, and it reveals how disconnected stock prices are from business fundamentals. It's the Tesla stock paradox. Sales are collapsing, but the stock barely dropped. Let me show you the disconnect. Tesla reported the worst sales numbers since 2022. Her deliveries missed estimates by 25,000 vehicles. Full-year sales fell 8.6%, the second straight year of declines. The company lost its EV crown to BYD. Brand damage from Musk's politics is severe. And how did the stock react? Tesla shares fell about 2% on the news, just 2%. The stock closed around $450, down from its all-time high of $479, but still up 11.4% for the full year 2025. This makes no sense from a fundamental valuation perspective. Tesla's core business, making and selling cars, is failing. Sales are declining, market share is eroding, competition is crushing them, and brand damage is severe. But investors don't care. Why? Because Musk has successfully pivoted the narrative from Tesla is a car company to Tesla is an AI robotics company. Analysts like Dan Ives from Wedbush are now valuing Tesla based on future robo-taxi revenue and humanoid robot potential, not current car sales. Ives wrote, "Heading into 2026, this marks a monster year ahead for Tesla and Musk. The march to an AI-driven valuation for TSLA has now begun with FSD and Optimus representing the golden goose." Translation: ignore the dying car business. Focus on the sci-fi future products that don't exist yet and may never generate meaningful revenue. This is classic growth stock bubble behavior. When fundamentals deteriorate, bulls shift the narrative to distant future promises that can't be disproven today. Tesla bulls argue robo-taxis will generate 100+ billion in annual revenue by 2030. Optimus humanoid. Robots will be bigger than the car business. Full self-driving FSD will revolutionize transportation. Energy storage business is growing rapidly, 14.2 GWh deployed in Q4. These are all maybes. Robo-taxis face massive regulatory hurdles and technical challenges. FSD has been coming next year for a decade. Optimus is years from commercial viability, and energy storage, while growing, is a small fraction of revenue. Meanwhile, the actual business, car sales, is in free fall. For Q4 earnings, due January 28th, analysts expect a 3% sales decline and a 40% drop in earnings per share. If Tesla were any other company, a 40% earnings drop would crater the stock. But Tesla investors are betting on Musk's vision, not current results. This creates a dangerous situation. If robo-taxis fail to launch on time, if FSD doesn't achieve Level 5 autonomy, if Optimus development stalls, the entire AI valuation thesis collapses, and then investors will be left holding stock in a declining car company, trading at 60x earnings. The Tesla stock paradox. The business is failing, but the stock is fine for now. So what should investors actually do? Here's the investment decision every Tesla shareholder and potential buyer is facing right now. If you own Tesla stock, you have two choices. Hold if you believe in the AI robotaxi thesis and think Musk will deliver on his promises over the next 3-5 years. But understand you're betting on future products, not current business performance. Sell if you invest based on fundamentals. Sales declining, margins compressing, competition winning, brand damaged, these are not bullish signals. At 60x earnings for a company with falling sales, you're paying a massive premium for hope. If you're considering buying, wait. There's no urgency. The stock trades near highs despite deteriorating fundamentals. If robotaxis disappoint, FSD delays continue, or car sales keep falling, the stock will drop 30–40%. You can buy cheaper later. Alternative plays if you want EV exposure, consider BYD. The actual EV sales leader, growing rapidly, traditional automakers, Ford, GM making solid EVs at reasonable valuations, EV infrastructure, charging companies that benefit regardless of which cars win. The bottom line, Tesla is no longer a car company in investors' eyes. It's a speculative AI robotics bet. If you're comfortable with that risk and time horizon, hold or buy. If you want to invest in actual profitable car companies with growing sales, Tesla isn't it. The sales numbers don't lie. Tesla is struggling. The stock price suggests otherwise. One of these will eventually be proven right. So we've covered Tesla's historic collapse. Sales fell to lowest point since 2022, 418 down 27 Q4, down 15.6%. How Musk's political backlash destroyed the brand, 38% of buyers won't consider Tesla due to his politics. The $7,500 tax credit elimination that made every Tesla effectively more expensive overnight. BYD's global domination as they outsold Tesla 2.26 million to 1.64 million for the first time ever. And the stock market paradox where investors ignore collapsing car sales, betting on robo-taxi or AI dreams. These are the realities every Tesla investor must face as 2026 unfolds. But here's something I didn't tell you at the start of this video. Everything I just shared is completely useless if you don't know which EV companies will actually dominate the next decade and which stocks are better buys than Tesla at current prices. Without knowing the winners and losers in the EV race, you'll miss the opportunities while holding a declining stock. Comment under this video, and I will reveal the 5 EV stocks that will crush Tesla over the next 5 years, including BYD's path to 4 million vehicles annually. I'll see you in the next one.